Good afternoon, everyone. Welcome to Zensar's session at the 2021 edition of the RPG Annual Investor Conference. Thank you all for joining us today. I hope that all of you are safe and well. We will be starting the session with a short video. This will be followed by a presentation by our CEO, Ajay Bhutoria, and finally a Q&A session with Ajay and our CFO, Navneet Khandelwal. A quick reminder to our audience, the presentations are available in the resource center of the landing page, which is www.rpgaic.com, as well as the Zensar website. Please view the presentation full screen for better readability. We will start with the video, which will be followed by Ajay's presentation. Thank you.
In a world where the way we live is ever changing, technology that doesn't meet people's needs becomes redundant. That's why, at the heart of how we think about technology is purpose, speed, and direction. By helping our clients do the right thing in the right way, with velocity, through purposeful change. Driven by customer experience. Underpinned by engineering excellence. And supported by solid foundations. But we know that change is not straightforward, so we bring in scalable systems and processes which help businesses react and adapt. Whether it's re-engineering application landscapes that help a retailer pivot to start delivering essential items in just 36 hours. By leveraging our creative and engineering capabilities to offer financial interfaces a friendlier face. Or deploying advanced data engineering to transform data quality and cost optimization. Our expertise is only as strong as our talent that comes from our globally diverse teams. Full-stack developers, application engineers, designers, technologists, consultants, all collaborating towards new revelations that help you to innovate and adapt so that together we thrive. Zensar, engineering the experiences of tomorrow, today.
Good morning, good evening, good afternoon, folks. My name's Ajay Bhutoria, dialing in from Princeton, New Jersey, in the United States. We are at the end of the RPG Annual Investor Conference, and clearly they have saved the best for the last. In the next 30 minutes or so, I will give you an update on Zensar, and I look forward, along with our CFO Navneet and Arjun, to an interactive session. I came on board Zensar earlier this year in January, and straight away immersed myself in the company. In the course of the last several months, I've spoken directly one-on-one with over 60 clients. I've spoken one-on-one with over 150 leaders of the company, worked closely with the board, engaged with analysts, a lot of whom are present, I'm sure, out here today, to get an outside-in view. And we have set about a strategy and a plan for the future. Today, we will start with a very brief look back and then spend bulk of our time to give you a view of the strategy and how we are going about to operationalize it. Next slide. So a quick look back, Zensar, as you all know, has been in existence for over 5 decades. I've been in the business for over 35 years, and I always knew, of Zensar initially as Ikem, Fujitsu Ikem, and then rechristened as Zensar at the turn of the century, which is also when we started focusing very significantly into system integration as a business. The first few years put the core of the firm in place. Some of our clients, including our largest client, date back from that era. Our largest client's been with us for 20 years now. And that gave us a solid foundation. Moving on, about 5 years back, we had a change of leadership. And also we initiated our program that we called, a campaign that we called Living Digital. As a part of the Living Digital initiatives, what we did was we implemented an economy of applications within the company with an objective to rewire the internals of the company and make it look and behave and operate as a digital native. A very successful program. The Living Digital initiative, by the way, has been featured in reviews by London Business School, Harvard Business Review. Very successful. Also, the last 5-6 years have been pretty fruitful from an M&A perspective. Our strategy was and continues to be tuck-in acquisitions. Just to give you a sense of some of the valuable acquisitions that we made, we acquired Foolproof in the UK for experience services, and a similar acquisition of Indigo Slate in the US, again to drive our focus and thrust in the experience services segment of the market. We acquired a company called Keystone to drive our business in supply chain, especially within our consumer services business. We acquired a company called Synergure to help jumpstart mid-segment work in the property and casualty segment, driven largely through Guidewire. So, in all, a smart set of acquisitions that I found coming in. Now, from a perspective of the results, growth had been soft, as we all know, over the last several quarters. But at the same time, a very rigorous operational discipline put us in a place where we ended last quarter, for instance, with the best Ebitda that we had in over 10 years, right? The last year. We are a zero debt company. Our cash in books is over 166 million, which for a mid-cap company of our size is a significant war chest. It also, therefore, coming in, gave us as a team the war chest that we could use to invest into the future and to operationalize the strategy that I'm going to share with you in the next few. If we go to the next slide, starting with the perspective on where is the market, right? What are the market forces that are driving customer behavior, that are driving demand patterns, and therefore driving the book of work for firms such as us? First is that pandemic, if anything, has accelerated the digital agenda for our clients. This whole move towards touchless, contactless, online as a dominant channel, as you would have heard from multiple sources, has accelerated almost 3 to 5 years. What we also find looking at the market is that disruption is the key to staying relevant. One of the biggest sources of disruption and threat to the traditional players in the industry is coming from new entrants who are digitally native, who are nimble and agile, and who are going after the most profitable parts of the portfolio of our of the large corporations in the market. There is a huge thrust towards driving agile, and towards that massive amount of investments made towards moving into cloud to variabilize the operational spend, get out of as much capex as people can. And also a trend towards an expansion of the tech real estate that we have traditionally addressed. Traditionally, firms such as ourselves went after the CIO spend. As more and more elements of business become tech-enabled, the addressable market for companies such as us, for providers such as us, has expanded. So what was traditionally CIO has now expanded to the domain of Chief Marketing Officer, Chief Digital Officer. And also within the CIO world, the increased mandate that the CIOs have towards driving tech-enabled business transformation has gone up. And the result of which is a significant uptick in spend, be it around cloud services, be it around data analytics, AI, ML, be it around how the companies size up to face the threat of new entrants and the disruption that is being caused in the industry. If you go to the next slide. Now, what does this mean for Zensar? So the imperatives that all this has created for Zensar is it needs us to focus very heavily, very significantly on the opportunity arising out of experience transformation that our firms, that our clients are driving towards, and the corresponding work that results in the engineering space. The imperative for us is the increased need to drive velocity for our clients, faster go-to-market, faster product launches, quicker development projects. The dominance of the cloud providers in the tech narrative of the future also governs to a great extent how we shape our talent pool for the future. And the result of which is this burgeoning need and demand for cloud native skills. Coming out of this, we have charted out our strategy to revolve around 5 strategic growth opportunities or 5 strategic growth areas. The first one is experience services. Experience services as a SGO for us will be driven under an overall umbrella of Zensar Studios that converges the capabilities that we have from Foolproof and Indigo Slate. The second SGO for us is advanced engineering services, and that covers a couple of different areas. The first one is that what experience services provides is the tip of the spear. Typically, downstream work coming out of experience services into the engineering realm is about 5x to 10x. What we have done is under the umbrella of advanced engineering services, we have created the capability to catch this demand. And increasingly, as we see in a large number of the experience-led deals, is our ability to catch that downstream demand has gone up. The second part of advanced engineering services is this huge thrust in the domain of cloud native full stack work that our customers are demanding, and where the market demand has literally exploded in the last 18-24 months. That is SGO number 2. SGO number 3, closely tied to SGO number 2, is the work that we do around data engineering, analytics, AI, ML. SGO number 4 is the original core of the firm, still is the largest piece of our business, which is application services. But a part of this is also the work that we do around platforms, SaaS platforms, which are low-code, no-code platforms, which is also an area which has seen expanded footprint over the past, I would say, 2-3 years now, continues to expand. So was and continues to be a big part of our focus. And then finally, SGO number 5 is digital foundation services, through which we drive our work around experience-led infrastructure services. It's a service line that was completely revamped about 3 years ago. And over the course of the last 3 years, this whole solution approach and the framework that we laid down, which is experience first and experience-led infrastructure services, has really resonated in the market. We continue to do very well. The pipeline in this space remains extremely strong, and we will just continue with that going forward. If we go to the next slide, a quick view into the verticals that we operate in. So traditionally, we have operated in what we call as the 3x3x3 approach, which is 3 geographies: US, South Africa, United Kingdom, and Europe. 3 verticals: high-tech manufacturing, banking, financial services, consumer services, and 3 service lines, which we have now expanded into 5 SGOs. Now, the 3 verticals that we are focused on remains unchanged. The dynamic, however, in the verticals has changed a little bit, right? In high-tech and manufacturing, which is the largest vertical that we have, there is increased amount of work around proliferation of Industry 4.0. There is increased amount of activity, business activity around doubling down on service as much as equipment, and an increased emphasis on the as-a-service model that our clients now implement with their customers. In banking and financial services, we continue to be very focused from a sub-vertical and a micro-vertical and micro-value chain perspective. For example, within banking, it's not just banking, it is retail banking, commercial banking, cards and payments, capital markets, buy side, sell side. And our focus and thrust around domain-led engagement that continues within our banking and financial services vertical. In insurance, similarly, very focused on PNC insurance in the mid segment, now increasingly covering the large segment clients as well. Consumer services, a big area of focus, a big area of strength for us, suffered really badly during the pandemic for obvious reasons. This is the vertical that also runs our retail practice, where we see a little bit of a rebound, and accordingly we have, and I'll talk to you more through it, expanded our investment in that space. Massive amount of effort around, given the touchless, contactless growth of the online channels, increasing move from physical channels into e-commerce channels. What the resulting impact in terms of rewiring of supply chain, in terms of rewiring of merchandising, in terms of rewiring of how our clients manage their core of business is resulting, how they then want to also drive agility, rapid product launches, rapid feature launches, is resulting in an uptick in demand in that space. If you go to the next slide, from a geography perspective, back to the 3x3x3 that I talked to you about. US continues to be the dominant geography for us, gives us almost 70% of our revenues. We are verticalized in our go-to-market, intersected by the horizontals and the service lines, SGOs, very, very clearly defined for this market. UK and EU, which is dominantly UK and some EU, gives us just under 19% of our business. What we see in this market is, outside of our core business and our traditional business, the whole experience-led engineering story, where Foolproof and classic Zensar came together to drive this new narrative, to drive this playbook with our clients, is resonating extremely well. We see a massive uptick in pipeline, very productive logo harvesting in the last quarter or so. And the third geography is South Africa. Brings in about 12% of business for us. It's a geography that we dominate. We are like number one, number two in this geography. Extremely valuable set of clients we have. We work for the top tier clients in this geography. And also a lot of innovative, disruptive solutions that we drive for this client. Oftentimes, South Africa is a test bed, given the quality of work that we do with our clients, along with US and UK, for a lot of the innovative solutions that we bring. And it's a geography that continues to do extremely well. Going into the next slide, just to wrap up, three geographies. We'll continue to operate out of these three geographies. Three verticals. We'll continue to operate along these three verticals. Increasingly, there are adjacencies. Increasingly, there is some cross-vertical activity that goes on. We are tracking that very carefully. For example, high-tech manufacturing has led us to work on medical devices as a part of the high-tech manufacturing effort. It's an adjacency. We are covering that very well. So we'll continue to work on the core and around the edges. And then finally, from a service line perspective, the biggest two service lines for us are application services and foundation services, which is infrastructure services. We'll continue to remain very, very sharply focused to retain our size of pie, to retain the proportion of business we have in that space. But in terms of emerging areas, the areas that will see disproportionately high growth, tracking the market demand, is around experience services delivered through Zensar Studios with Foolproof and Indigo Slate as two banners. Advanced engineering services as a bolt-on to the experience services, and to drive our efforts in cloud-native, full-stack work and complex engineering that our clients demand as they transform their real estate. And then finally, data engineering, analytics, and AI ML, closely associated with advanced engineering services, is a space where, again, demand has exploded. The opportunities that our clients have seen in terms of real life use cases to get a leg up on market penetration, competition, etc., has gone up. And it's a space that we see significant growth is going to drive a lot of our future growth. Coming into next slide, just to give you a view, I often get asked a question. Look, these three service line along with the core two service lines. What about them? Are we bringing in new service lines? Are we trying to create new capabilities, etc.? Actually, even before I go here, just would like to emphasize that none of these 5 SGOs that we have identified, none of these 5 SGOs is new to us. To give you a sense, experience services already delivers about 10% of our revenues. Advanced engineering services already delivers close to 10% of our revenue, actually over 10% of our revenues, right? Data engineering services is already a sizable part of our portfolio. And just to give you a view into the work and the quality and the sheer interesting nature of the work that we do in this space, we've picked up a few use cases that we would like to share with you. The first one, is a case study that we have for a large communication provider out of the UK, right? It's a communication media company. We are redesigning their entire customer experience and content platform. They've created a new digital brand. We are responsible to drive the operationalization of that new digital brand. And we are doing this through complete experience redesign, sitting on top of a newly created experience platform that has been done by Zensar. And the result of this, we already see we are in phase 2, phase 3 of this program. We already see the results in terms of a significant uptick in terms of conversion rates, in terms of client engagement metrics. And this continues to be a very, very strong use case for us in the experience services segment. Go to the next slide. Another example that we'd like to share with you is for a large auction house. Start of the pandemic, everything shut down. And auction house is an old industry, it's been around for a couple of centuries now, and had to rapidly pivot to stay relevant into what was traditionally a very physical business into a completely virtual business. And what we brought to bear here is a solution framework that we have developed called Experiences Anywhere. And this was used to drive the first set of virtual auctions for this global auction house. The very first virtual auction that they did netted, $46 million work of 7 artists, and so successful that they have continued along this path. So another example of what we've done through our experience services practice. Third example, going to the next slide. And this is an example of what we are doing in advanced engineering services. Large departmental store retailer in the United States. Increased activity, especially and accelerated during the pandemic with rise of the online and mobile channel. Rapid need to rewire their supply chains to address what was earlier a dominant market share in physical stores into a pivot into online, mobile commerce, e-commerce, etc. We are building their brand new cloud native supply chain platform, starting with their warehouse management system. And this platform is being deployed on Google Cloud. So this is another example of how we are driving significant transformation for our clients using advanced engineering services as a practice. Next example is a global financial services corporation. And it's massive. It's a huge corporation. And the problem statement that was given to us was that we have very scattered real estate when it comes to how we are delivering on the brand, how we are delivering online experience, and the cost that associated with such a widespread of real estate across the globe. Our solution to them was we created a common platform. We created 200 components which were common and reusable on that platform, and then using that platform to render online channels for this client across the globe. And to give you a sense, immediately, effort reduced by 25%, cost savings of over 30%, reduction of 25% on drop-off rates, and what is not here is improvement of 50% in terms of turnaround time for new features, new products, etc., that they wanted to bring to the market. Another example that I'd like to share with you, going into the next slide, please. The one before, please. The one before. One more. Yeah, this one here. And this is an example of how our experience and engineering services came together. Actually, the previous one as well was an example of how our experience and engineering services came together. South African Bank, the campaign, the program that we ran with them was to completely reimagine the web experience that they were providing to their clients, right? And again, very similar to the previous example, we brought in the digital skills, we brought in the experience skills, and we brought in the architecture skills needed to create this new scaffolding to deliver the promise of the brand to their clients. So we built this, and as a part of this build out, as a part of the program, the mandate from the client was that we also help uplift the client associates and make them somewhat independent to do such programs in the future by themselves, basically to make their people increasingly digital ready and digital savvy. Very successful project. And some metrics like 25% increase in returning customers. 70% of the customers are now being onboarded digitally, right? So they don't have to show up in the branch. 70% of the customers, especially relevant during the times of pandemic, are being onboarded completely digitally as a part of the features that are coming out of this platform. Another example that I'd like to share with you is this is another, I'm very passionate about this particular. So we are one of the primary partners for a large international gaming giant. We help them with designing and creative work. We help them with build of these games. We help them with testing of these games. We help them maintain the past versions of the games. As we speak, about 100 such games are being either built by us or tested by us or maintained by us. The result of this is that we today, I believe, from what I heard here in the market, have the largest gaming, if not the largest, one of the largest gaming studios in the country in India today. Deep engineering skills together with creative content. This is a very special team. It's a very special set of skills that are needed to maintain gaming platforms. Another example, the next one. So for a large mobile network service provider in the US, the problem statement was that, look, we get a lot of these requests which are similar in nature. Is there a way to better service those requests? So the solution that we designed for these guys was around a sentiment analyzer. Right. So what we started doing was we started capturing all the data that was coming in, and we put a sentiment analyzer in place where we would track common requests and even preempt the resolution of the request before the call came in from the customer. Significant uptick in customer satisfaction. Another example, given the success of this, where they said that, look, similarly, we get a lot of these maintenance requests, typically comes in waves. Is there a way to catch them before we start getting calls. Again, we put the data warehouse in place, tracking the patterns of the calls, picking up patterns of service issues, and preemptively addressing those resolutions before the flurry of calls began. Very successful, extremely satisfied customer. This whole thing was built on a data platform and around a sentiment analyzer and other AI ML algorithms on top. Another example, large intergovernmental agency. Previous slide, please. Yeah, this is the second example on this chart. So large intergovernmental agency dispersing huge amount of funds across the globe, to run various projects, various social projects. So the problem statement presented to us is that, look, we want to track this better. We want to make sure that maximum amount of dollar that we disperse is used up in the end project. And we just like to do a better job of disposal, allocating, tracking, and managing the whole process of disbursement. So we created a global business intelligence center for this client. As a part of that, we created a completely new structure around data architecture, around data stewardship, around data governance, around ingestion of data, and around how the analytics and AI ML algorithms would run on this data to deliver the intelligence that they were looking for. And massive uptick in terms of quality of tracking of all of these disbursements they were making. As we last tracked, 99% achievement in terms of tracking, in terms of identifying how much of the dollar that was dispersed was used by the end customer. The reason I have shared all of these use cases is to give you a view of the fact that A, we are doing some really good work. B is the newly identified SGOs is not new to us. We already do sizable business, and we've got terrific use cases to prove and to evidence the quality of work we are doing in this space. And these are SGOs where we see massive amount of market demand in the coming future, and we are increasingly gearing ourselves to catch that demand. Going to the next slide. Changing tracks a little bit. Now, I talked about the 5 SGOs, talked about experience, advanced engineering, data analytics, AI/ML, application services, and foundation services. Just to share with you, the place where we have spent maximum time while charting out the strategy. So we worked through the strategy in my first quarter of the company. We started work early and then continued through the quarter, actually spilling over into the next quarter. The most important chapter in the strategy that we have charted out is around how we will operationalize and execute on this strategy. The first call out there is that we are operationalizing this strategy and operationalizing each one of these SGOs through between 2 and 5 playbooks per SGO. And then we have created a list of SGO, which is the inventory of the firm's list of playbooks, which creates the inventory of the firm's solutions to the market. And we have also created a list of, within this long list, a list of priority, a set of priority playbooks that we will execute on starting now. We've done very fine-grained documentation, very fine-grained work around development of these playbooks. These are already services that we have in terms of inventorizing, in terms of documenting it, and in terms of rendering these playbooks to our go-to-market teams, our pre-sales teams, and our key delivery teams. That's one key call out. The other call out is that we are executing this. There are 4 pillars that are critical in executing this strategy. These 4 pillars are increased investment in sales to drive growth, be it in terms of people, be it in terms of expansion of and an enrichment of the sales process, and be it in terms of how we are doing some tweaks, some rewiring to just better enable sales. That is pillar number one. Pillar number two is what we are doing with our partnerships. So very focused on partnerships with hyperscalers, very focused on partnership with some platform providers, and a very clear investment strategy of how we will double down into those partnerships, both in terms of the engagement as well as in terms of the capability build out that we have around these product partnerships. Third critical pillar is what we are doing with talent. So talent is a massive focus. It's something that I'm working on directly with the talent management team, with the delivery folks, with the key leaders of the firm. How we elevate our talent game, both from an organic onboarding perspective, as well as from inorganic perspective in terms of lateral hires, in terms of M&A, and in terms of talent from other geographies. To give you a view, from an organic perspective, how are we looking to enhance, and significant work on that already underway, our onboarding engine, both in terms of how we catch the talent coming out of colleges and how we train them to minimize the time between onboarding them in the firm and their day one of billability and productivity. Right? So significant effort going on in that, already bearing very fruitful results. Second one is the sheer recruitment effort that we have put in place to capture lateral talent. Third thing is, we all know the talent market in India is hot. The labor supply is very inelastic, and not just India, India and in the markets. And we are looking to expand that talent supply chain outside of India. To give you an example, we already have a center in Poland for delivery. We will increase that. We will increase our investment in Eastern Europe in terms of creating talent supply chains out of that geography. The fourth important pillar is mergers and acquisitions. We've had a good track record of tuck-in acquisitions in the past. Going into the future, any acquisition we do will be along one of these 5 SGOs. And I've shared with some of you in the recent past, the latest acquisition that we did, M3BI, addresses 2 of the 5 SGOs, advanced engineering services, which is about half their business, and data engineering, analytics, AI, ML. They're doing some really, really good work around big data, analytics, AI, ML. That's another 50% of their business. So there are 2 SGOs that we address out of this acquisition. So any future acquisition that we do has to bring in capability, increased access to skills, and increased access to markets. And again, through M3BI, just to give you a sense, we have acquired 5 global Fortune 500 and US 500, Fortune 500 clients. Very, very haloed names in the industry, and gives us an ability to upsell, cross-sell traditional Zensar services outside of the work that M3BI does. And of course, the M3BI capability and skills that we take to our existing clients and to our new clients in the market. 4 pillars. Next slide. Quick update on the execution, on operationalization, on talent build out, in terms of talent transformation, leadership augmentation. I already spoke about M&A. I already spoke about talent transformation. As we speak, happy to announce bringing in new leaders, right? So just to give you a view, right? I have been lucky to have inherited within Zensar a solid foundation, great set of clients, like us a lot. If they have a problem, we are one of the first people to get a call. Passionate set of associates, and a strong, process mature, resilient company. So good foundation. We are, augmenting some lateral leadership from outside. We brought in a new head of consumer services. That position was vacant. We just filled it. Very strong leader brought in the firm. We just brought in a new leader for Salesforce, SFDC, cracker of a guy. already creating ripples in terms of market access, in terms of generating pipeline and demand. And we will continue to onboard talent in leadership and across other levels of the firm. And we may also tweak, rotate a few people around within the firm to drive better effectiveness, better throughput, better market access, and better delivery. So just to give you a view in terms of how we are, off to the races, implementing and executing on the strategy. We are not waiting for it. Next slide. So path forward, a quick summary. We have crystallized our services through SGOs and playbooks, put a structure, put a very focused and clear set of services that we take to our clients to drive their value proposition, to provide them with solutions they need, and to give our sales force a very clear service that they can take to the market, set of services that they can take to the market. Expanding sales enablement, expanding investment in sales, expanding our reach into the market, and expanding access and expanding our focus on building existing logos, farming existing clients that we have, the large number of existing clients that we have in our portfolio, and also going after new clients and new logos. With that, next slide. I'd just like to, I thought, I'd give you a sense of what we've been doing, give you a view of the strategy, give you a view of how we are operationalizing and executing on the strategy. Typically, a strategy exercise of this kind I've shared in the past takes, you see the green shoots fairly immediately. But for it to drive, what is our goal? Our goal of driving predictable, sustainable, and profitable growth. So the predictable, sustainable comes in a strategy refresh of this kind, in a turnaround of this kind, in 4 to 8 quarters. And the initial signs of how we are executing have been very positive. And look forward to sharing with you updates as we go along. With that, I'd like to close my presentation and open it up for Q&A. Arjun, back to you.
Thank you, Ajay, for that preview of Zensar's strategy and path forward. As we now move into the Q&A session, we will be joined by our CFO, Navneet Khandelwal. Thank you for joining us, Navneet. A reminder to the audience, please ask your questions either by raising your hand, and we will then let you ask the question live, or through the Q&A chat box. The first question comes to us from Manik Taneja. Manik, please unmute your line and ask your question.
Hi, am I audible?
Yes, Manik.
Yes, Manik, please go ahead.
Yeah, hi, am I audible? Hello.
Yeah, Manik, we can hear you.
Please go ahead, Manik.
Thank you for the opportunity and this splendid presentation today. Basically, just wanted to take your thoughts around what do you think ailed Zensar in terms of the growth underperformance in the last few years. And you said that we embarked on a digital transformation journey much earlier than some of our peers. So what essentially ailed Zensar over the last few years? And why do you think this time around the results may be different? And then the second question essentially is that you talked about this move towards predictable, profitable, and sustainable journey. So how should we be thinking about the investments on sales and marketing? Yeah.
Yeah, Manik, thanks. So your voice was a little soft. Just to play back your question, why has growth been soft? What is changing going forward? And what are we doing about sales investments? Did I get it right?
That's correct. Thank you.
Okay, good. So first of all is, yes, growth has been soft, right? And many different reasons, right? Well, just soon as I came in, I've been spending inordinate amount of time to get to the root cause of what has been the reason for this softness in growth. So few call outs. The first one is that the portfolio of the clients that we've had have been inordinately impacted by the pandemic. Their business shrunk, and as a result, their expenditure they basically cut down their expenditure, which resulted into diminution of their spend with partners such as us. Now, unfortunately, a large number of our clients, a big part of our portfolio, some of the dominant clients we had got impacted pretty badly because of the pandemic, and the resulting shrinkage in their expenditure impacted us. So that's one. As I often like, to call out, is that if the dominant clients in our portfolio were clients that increased their footprint, increased their business during the pandemic, as we saw with hyperscalers, as we saw with some of these large tech giants, the growth trajectory for Zensar may have been completely different. So that's one. Second thing is that going into pandemic, look, we all remember, all hell broke loose and it was Armageddon, and we didn't know how things would end. And we did what everyone did, which is we said, let's preserve the business, let's preserve cash, right? Let's tighten the operational levers. Looking back, hindsight is always perfect 2020, is that we kept that dialed up for a little longer than we should have. I don't think anybody anticipated that the rebound in demand post-pandemic will be as quickly as it happened, right? I think pretty much quarter and a half into the pandemic, we already started seeing some rebound in demand, and which then caught on momentum Q2, Q3 into the pandemic. Maybe we kept these operational levers and the operation discipline that we constituted at the beginning of the pandemic, we kept that dial too tight for a bit too long. That kind of reduced our ability to go expand, sell into the market, etc. The third thing is, Manik, if you've seen traditionally, this is an important call out, right? 85% of our business came from what we called as digital application services. 85%. Over a period of time, this huge mass of business had become undifferentiated, although we were doing very good work, very satisfied clients, extreme high quality work, but this big block of companies' business had become undifferentiated. We were finding it difficult to drive value proposition to clients. We were finding it difficult under this massive block to create customer conversations because high resolution services just got lost in this mass. The single biggest effort that we are making as a part of this strategy is to provide better structure in form of these 5 SGOs, right? So instead of one DAS, now there is DAS 1, DAS 2, DAS 3, DAS 4, right? Around that, creating a very crystallized set of services, which we can then take to market, which removes ambiguity, completely removes ambiguity that our sales force has towards what they are selling, who they are selling, what is the value proposition they are driving. And this is defined at very granular level in an extremely high resolution format per playbook. This has already started yielding results in terms of how we spot opportunities, how we engage with clients, how we drive proactive and RFP-driven proposals, and how we are winning business. So just to give you a sense of what was in the past and why how we are charting out strategy for the future is going to change the trajectory going forward. Your question on sales. We are lucky. Best Ebitda in 20 years or 10 years, 20 years, zero debt, significant cash balance despite regular payout of dividends, gives us a war chest, and we are tapping into that war chest to expand our sales capability, our sales process, and our sales headcount. Be it hunters, be it farmers, be it pre-sales people, be it senior delivery guys. We're also tweaking how we have wired the organization in terms of go-to-market and delivery just to better enable sales. We are putting huge amount of investment in terms of talent acquisition, in terms of creating talent pool of the future, right? And with the war chest we have, we will continue to drive smart tuck-in acquisitions, increasingly in the space of advanced engineering and platform-based services around some of these SaaS platforms. Confident that this will anchor, will take root. We already see green shoots, and this will stabilize and will give us what we are looking for, which is sustainable, predictable growth.
Thank you, Ajay. If I may, just wanted to get your thoughts around the pricing environment in the sector. Given the tight talent market, everybody's just been scrambling for talent. And given the underlying demand strength, do you think we probably get some pricing benefit from customers?
That's a good point. Let me back up, give you a slightly elaborate answer, because it's not a straight answer to this question. So you're right, the demand environment is rich. You're right that the supply is inelastic. Okay, this demand supply mismatch is creating inelasticity in supply. There is shortage of good skills. Now there are two things that are emerging out of this. One is that for our clients, the effort to reduce their run cost and invest into change and growth has shot up. Okay, because the available pie is the same. And therefore, we will see increased activity in terms of them shrinking their run costs and doing deals where they are seeking, and you've seen based on the deals that you have, I'm sure, tracked in the market, large mega deals at incredibly low and commoditized prices, right? Where they are going to drive down costs significantly. These deals basically yield for the clients 30 to 40% saves, cannot be achieved without a very, people talk about automation, etc., but the first lever is reduction of labor cost. And that effort to commoditize is creating a massive shrinkage in terms of cost that can be applied to these projects, labor cost being the primary one of it. On the other side, on the change side, with the amount of effort that is going towards cloud native build, the amount of effort that is going on in building big data harnesses, driving increasing number of use cases around AI, ML, analytics, etc., that skill is becoming more and more premium. And over a period of time, the cost of the skill goes up, in a linear curve. The pricing change that, the pricing that we can charge to our clients usually moves in steps. And yes, over a period of time, I think there is going to be pricing gains that firms such as ours can apply, given the sheer mismatch of demand and supply for that skill. Sorry, long answer, but I just wanted to give you, it's a tale of two cities.
Appreciate your inputs. Thank you and all the best for the turnaround.
Thank you. Thanks, Manik.
Thanks, Manik. The next question comes from Sandeep. Sandeep, please unmute yourself and ask your question.
Hello, can you hear me?
Yes, Sandeep.
Hey, hi. Thanks for giving me the opportunity and very, very honest answer to the previous question. So I have only very simple question, Ajay. Since you have joined, right? How have you allocated your overall time till now between building a team, building relationship with client, fix operational issues, promote performance, and build capability? That is my one question. So how have you allocated your time between these 5 functions as a CEO? And second, when you report to your board or chairman, again, how do you spend your meeting time, whether it is 30 minutes, 40 minutes, 15 minutes, whatever, between these areas? I don't want to know what you discuss with them. I just want to know what is your ratio of time you spend on each of this area when you discuss. That's it. A very, very simple question. Please help me with that. Thank you.
Sure. So I'm not sure I captured all the 5 areas that you spoke of, but let me give it a shot. So after I came in, like I said, and let me share an example. I joined on 7th January. I was basically onboarded into the firm 8 a.m. US Eastern Time. My first client meeting, a 1-hour meeting with a client was at 10 a.m. And since then, the engagement with the client has been nonstop and continuous. To date, I've spoken to 60 plus clients, many of them multiple times over, so second, third, fourth meetings. So deeply connected with the clients. And the objective was first is to reassure them that, look, change of leadership, you're in good hands. Second thing is that, look, just tell me what's been working, what's not been working, give me inputs as we shape strategy for the firm. Third thing is, what is your aspiration from a partner such as us? What would you like Zensar to do for you in the next 12, 24, 36 months? And then in the second, third meetings, we have gone and replayed that, look, here's what we are doing. What do you think? And sought feedback. A massive amount of time in that. Second big chunk of time is, my background is I've been in the industry for a while, worked for 2 very sizable and respected firms, have been a part of multiple such turnaround discussions. One thing that I've realized is getting feedback from the ground is critical. So immediately after joining in, I started engaging with associates of the firm directly on one-on-one conversation, 30-minute calls. And I gave an inordinate amount of time in the early so to get their feedback. What do they think? What excites them? What are they passionate about? What are their fears? What are their apprehensions? What would they like to do? What do they aspire to do? Right? 150 people plus to date, one-on-one conversations. I've been, with the board, with the chairman, continuous dialogue, right? And then, about a month and a half after I joined, we started working on the strategy. And as you've seen, the strategy has, markets analysis, clients analysis, patterns and demand trends of what we see in the market and how that impacts us. And then coming up with this structure of 5 SGOs, coming up with the list of playbooks that we have for operationalizing these SGOs to execute on these SGOs, and then also determining what we do with sales, what we do with talent, what we do with partnerships, and what we do with M&A, right? And we spent, we went through a 8 or 10 week sprint to put this in place, multiple iterations, very, very engaged conversation with the various stakeholders that we operate with, including, with a few customers, a readout to get their reaction that, okay, are we on the right track, right? What's their reaction? Are we going to meet their expectation of us in the future? So it's difficult to quantify how much time I spent in each, but I have spent a lot of time. My day starts typically at 6 a.m. in the morning here in the US and then ends until late. And I've spent a lot of time. It's tough to quantify, but all of these are critical aspects. Our SGOs, our playbooks, what are we doing with sales investments, sales organization? What are we doing with our delivery investments, delivery organization? What are we doing with partnerships, with M&A? So if you ask me which is priority, I think all of them have been priority conversations.
Great. Thanks, Ajay, and thanks a lot for this answer. I will ask half or less than half question one also.
Sure.
It is not a complete question. It is a very, very small question. So I don't know whether it is a full question also. Uh, when you mentioned one point in the previous question to Manik that you people went little ultra careful during the pandemic or restrained. Was that your thought process completely, or there was a hook behind?
What do you mean there was a hook behind?
I mean, something was like, kind of you were scared that, you may burn a lot of money if you go aggressive, something like that. I mean, was there some baggage or something? So just want to know why you did not go aggressive, because with the kind of experience you come and the firms you have worked, and I have seen all the great work you have done in your career, you could have easily sensed that there is a huge, huge wave coming of demand, because this wave is not something which you would have come to know in like as analyst in last 3 months. You would have seen much before us, because you sell into Microsoft, you sell into AWS. So I don't believe that you were not aware that such kind of tailwind will come. Means it is very hard for me to understand that.
So, Sandeep, to clarify, I was not around when these decisions were made, right? So when we started Q1 of pandemic, which is, roughly starting about March 2020, right? And March through June is when pandemic was at full force, lockdowns, etc. And June onwards, things started changing, and there was a sudden pivot in demand that happened in July August timeframe. I wasn't around, Sandeep.
No, I know that you were not around. So
This
I'm
time,
asking only
this
from
time I
Jan
got
2021.
Jan 2021. We have pivoted, my friend. We have pivoted, Sandeep.
Okay, great, great. So I just wanted to know that from that time there is nothing which have stopped you, right? You have become very aggressive.
Yeah. I'll tell you, we brought in new head of consumer services. We're bringing in new head of consumer services delivery. We brought in a new guy for, managing delivery for banking financial services. We brought in hunters. We brought in, new farmers in the field. We've made a few rotations, a very critical rotation. Appointed a new leader for our STM business. We've been working overtime on that.
Thanks, Ajay and team.
Just wanted to clarify, when the decision to keep the lever tight is again hindsight 2020. I can't say whether it was the right decision or not. I wasn't here then, and one could easily say that, look, maybe it was the right decision, maybe it was not, but it was a decision that impacted our growth, right? And I wasn't around then. Going forward, very clear. We've got a war chest. We are going to invest from that war chest to drive future growth.
Thanks, Ajay, and thanks a lot. And I see a lot of energy the way you have managed, and I completely am aware when you have joined. So I was not asking for the prior period. I was just asking after you came if there was anything which was controlling, means you were not sure or you were a little scared. So as you rightly said, already clarified enough that you have been very aggressive in building team and capability. I hope you do extremely well in future. Thanks and best of luck.
Thank you. Thanks.
Thanks, Sandeep. The next question comes to us from Mukul Garg. Mukul, please unmute yourself and ask your question.
Thank you. Good morning, Ajay.
Good morning, Mukul.
So, Ajay, one question which very interesting presentation. One point which was clearly an undercurrent throughout your presentation was on in experience services. You mentioned that it is now about 10% of your revenues. What is changing now in your go-to-market approach for engineering services? They continue to remain a very, very high growth area across regions, but have had limited benefit for Zensar's since the acquisitions over last 3 years. So if you can help us understand what changes you are making internally, which can turbocharge and provide support to the other four SGOs from an experience point of view. And the second question was, again on the supply side, it was asked earlier, but if you can help us clarify the steps you are taking to stay ahead of on the attrition game. It clearly is packing across the industry. Do you see a risk on growth and profitability because of the supply crunch which is happening, or do you think it has more as an opportunity?
Mukul, good questions. And let me go one at a time. So when this whole campaign to become digital began, right? Zensar took a very early decision to invest in experience, and they bought Foolproof and Indigo Slate, valuable assets, right? Foolproof is now completely integrated. Indigo Slate is in the last year of their SPA, and through them acquired a set of strong capabilities around experience and product, research, strategy, design, right? And then they've done some really, really remarkable and cool projects. If you look at their portfolio of very good projects around experience and product, research, strategy, and design. And then within Indigo Slate, a lot of work around uh, content and creative services, including brand campaigns, etc. So coming in, this was already, when I came in, this was already an asset. One of the areas where there was a discussion that was going on, and it's something that we doubled down very, very quickly, put immense focus immediately after I came on board, is that the work that we do in this space gives us a lot of, it's a tip of the spear, gives us a lot of mind share with our customers, but the real volume of business comes in downstream technology work to deliver this product or this experience, right? And I've spent inordinate amount of time defining how we'll catch that downstream work through the advanced engineering SGO that we have created, right? Like I mentioned, part A of this is bolt on to our experience services so that we can catch the ensuing demand. By the way, which industry standard, not us telling you, is between 5x to 10x of the original dollar that is spent on product or experience, research, strategy, and design. So massive amount of effort to create that. The reason for bringing in M3BI was also to double down on that. And our big M&A focus of the future is also to continue to enhance our capability in that space. Because what we get out of that is not just catching experience demand, but this massive opportunity that has arisen in the market through cloud proliferation is also going to be serviced by this particular capability. This SGO houses are cloud native full stack builders. Okay. And by the way, experience is engineering and data engineering. So data engineering and advanced engineering kind of go hand in hand to cater to this demand pipeline. So to give you a view, right? Doubling down, increase investments, very, very sharp focus on building this team into a high resolution structure. We already were making investments. We are doubling down and investing even more, right? And M&A tuck-in acquisitions to cater to this particular area of growth. So Mukul, that's the answer to your first question. When it comes to talent, there are three attributes, there are three dimensions of talent, there are three levers of talent that we are focused on. Right? The first is onboarding fresh talent, right? The whole program around how we go to colleges, what colleges we go to, how we bring in talent, how we put them through a training program, what kind of training do we do to give them hands-on experience, and how do we minimize the time between onboarding them and their day one of productivity? Massive area of thrust. I'm spending a lot of time with our delivery leaders, with our HR, CHRO, to fine-tune this even further. So that is one. Second thing is lateral talent. You can't survive without, right? So we have increased our ability to catch lateral talent. We have onboarded more recruiters, and how we go into to catch that talent, we have significantly amplified that game in the last 5 months, right? The first month for me was, learning, didn't want to take any knee-jerk steps, absorbing. But the last 4 months significantly amplified the game. Third area of big focus for us is non-India geographies, and extremely focused on East Europe. We are close to bringing in our leader for East European delivery, an extremely, extremely seasoned person. And so we are already in Poland, like I mentioned, in Krakow. We will continue to expand that to bring in that talent. To the last point, the last question, Mukul, is what does this do in terms of attrition, etc., cost of labor? So in the short term, yes, given the sheer inelasticity, and you track the market, Mukul, you track multiple companies, you closely follow this, right? You would have seen that labor supply has become quite inelastic. Attrition rates have gone up, right? As it has for us and our peer group. In the short term, there may be pricing pressures, margin pressures coming out of this. We are tracking it very closely. We are watching over the space very carefully, right? And to the question that Manik put forth early on is that we are also watching over not just the attrition but also the cost of lateral talent and what we need to do in terms of client conversations for rate changes, etc.
Great. Thanks a lot for answering the questions, and best of luck for the years ahead.
Thanks, Mukul.
Thank you, Mukul. The next question comes to us over the Q&A chat. What are the sustainable levels of Ebitda margins which you envision in the medium term?
I would like Navneet to respond to that question.
Yeah, sure. Thanks, Ajay. Actually, we've exited last year with an EBITDA margin of about 19.9%. That surely is pretty high. As Ajay has called out, a very integral part of our strategy is to invest in the sales, and to that extent, we will be hiring talent to actually accelerate our sales in line with our strategy. This will lead to some level of moderation in our margins. At the same time, there are supply side pressures which are coming up. We gave a wage hike in January, and we have already announced that from July 1st, we are going to be giving another wage hike. So that would definitely put some pressure on the margins in the short term. However, we are very clear that we will continue with our focus on the operational matrices. We think that there are significant amount of levers available to us in terms of the offshore mix, which should continue to be within the range. Also, the offshore per person cost is somewhere through a good pyramid correction, we should be able to contain costs. And lean and automation would continue to be the focus areas. We believe that travel costs, which has been a significant saving for us during the pandemic, will come back, but it will not come back to the full rigor that it used to be in the past. So it's going to be increasing gradually. But with the combination of this thing, you will see some level of moderation in the margins. We've consistently been saying pre-pandemic that 15% EBITDA was the target that we had. We'll clearly be ahead of that. And we should be in the medium term at a margin levels which are high teens. So lower than the levels that we exited, but somewhere around high teens is the level that we should be on the EBITDA side.
Thank you, Navneet. The next question also comes to us over the Q&A chat. The M3BI acquisition fits in well with the strategy undertaken by Zensar. What are the criteria that you evaluate when considering a potential acquisition?
Yeah, good point. The three criteria, and I know it. The answer is so ready because those are the criteria: is the capability that the acquisition brings us, the skills that we get out of the acquisition, and the market access, that is the clients that we get from the acquisition. Any acquisition that we do in the future will align with one or more of these SGOs, right? And then capability, skills, market access.
Thanks, Ajay.
Thanks.
The next question comes to us from Sudhir Guntapalli. Sudhir, please unmute yourself and ask your question.
Yeah, good evening, gentlemen. Good morning, Ajay. Thanks for giving me this opportunity. My first question is an extension of one of the previous questions. So you said in terms of what has not been working with us so far, you kind of explained the events that played out since the onset of pandemic or subsequently. Of course, we understand COVID-19 is a black swan event which would have impacted the entire industry. I don't think anybody can do anything about it. But if you look at the period before that, right? If you look at the 5-6 year period before that, despite claiming that we are one of the earliest providers of new age services like digital application services and all, if you see, our organic growth rates would have lagged the organic growth rates of other mid-cap IT companies by at least half, right? There's a significant margin or significant differential in terms of the organic growth rates that Zensar was delivering versus the organic growth rates delivered by, let us say, some of the mid-cap companies like L&T, Infotech, so on and so forth. So if you take a slightly longer term view and keeping aside the set of events, the chronology of events that happened post the pandemic, what do you think has not been working with us, and how is that going to change going ahead with our new strategy?
Right. So let's go to the period pre-pandemic, right? And our growth rates versus that of the peer group. Let me go all the way back. So, turn of the century in the early 2000s, Zensar was known to be a very strong Oracle shop, right? A big part of the portfolio, a big part of client acquisition, big part of growth came from the work we were doing around various Oracle platforms. Then, this whole digital conversation became very dominant in our industry segment. And what we ended up doing was took our eyes off the Oracle ball and put massive amounts of focus into new emerging digital areas. Again, hindsight 2020, right? You can always look back and have the best view. Any prudent future, revolves around moving S-curves, right? You have your existing cash cows, you have your existing portfolios, you have your existing sources of business. And then you have to continue to expand into new areas to stay relevant, right? But always, the focus should be, how do I continue to sustain the core strength of the company as we invest into newer areas? Looking back, we probably took our eyes off our core growth engine, our core sustenance engine too quickly while pivoting into digital areas such as experience design, etc., which were new capabilities for the firm, which are capabilities that take time to settle, anchor, and take roots. One of the reasons why I think we suffered, average growth and relatively less growth versus our peer group. I just wanted to call that out. And in the future, as we look forward, we are obviously not committing any of the same approaches that we took at that time. We continue to be sharply focused on application services and digital foundation services. We are going to monetize further the work that has already gone in experience services over the last 4 years. And we are doubling down on two areas of the firm which already comprise a significant part of the firm's portfolio: advanced engineering services, over 10%, data engineering services, also very sizable, and double down in those areas, right? So just to give you a very transparent view in terms of what happened pre-pandemic and how are things going to look going forward. We are very, very clear. We've done our analysis. We've done the root cause analysis of what happened and what should have been.
Sure, Ajay. And the follow-up question. So, with the current strategy that we are talking about and we are confident about, how confident are we that will probably reach, let us say, mid-cap growth rates, which might be, if I were to call out, in the range of 13 to 14% dollar revenue growth in the steady state? Uh, how confident are we in terms of converging with that sort of industry mid-cap growth rates? Forget about FY22. FY22 may be a bit of a base shift year, but in the steady state, in over the medium term, how confident are we in terms of achieving that growth with the new strategy in place?
Let me answer, Sudhir, the question slightly differently, right? So you're right. A strategy refresh of this kind takes time. My own experience, I've done several such turnarounds, is it's a 4 to 8 quarter affair. Okay. Coming in, right, when I was interviewing, I always knew Zensar, right? And I did my analysis outside looking in. You know what? It's a great engine, which, if primed properly, if tweaked properly, had potential to truly deliver strong results. This was outside in, when I was, in the process of interviewing sometime late towards the end of last year. 5 months into the job, my belief in that, if anything, is stronger. Short answer, background and a short answer at the end.
Sure. So we are confident that we'll reach, industry mid-cap growth by, let's say, FY23 or so.
So without going into numbers, I'm very confident on delivering to our aspiration of predictable, sustainable, profitable growth.
Got it, Ajay. All the best, and thanks for giving me the opportunity once again.
Thanks, Sudhir.
Thank you, Sudhir. The next question comes to us on the Q&A chat. Given our healthy cash balances, could you please throw some more light on our capital allocation strategy?
Good. It's a good question for Navneet.
Yeah, sure. Actually, we exited the year with a cash balance of about $166.3 million. As you've already seen that we have announced an acquisition where some amount of this cash will be used. Ajay was very clear in terms of the strategy that we have rolled out. And one of the pillars of the strategy is looking for the M&A which fits our SGO strategy. So we are preserving and conserving cash to be able to use it for any potential M&A which should come in the areas that we have identified, aligning with our strategy and our vision for growth. In terms of how our dividend distribution policy is going to be, this is an element which has been fairly consistent for Zensar over years. Our dividend payouts have consistently been between 20 to 25% of our PAT, and that as a principle shall continue for us. We are very clear that the war chest that we have got right now will be utilized to accelerate growth for ourselves and towards realizing the strategy which Ajay has just talked about shortly.
Thank you, Navneet. The next question comes to us from Sandeep Shah. Sandeep, please unmute your line and ask your question.
Yeah, thanks for the opportunity and good morning and good evening. Ajay, just wanted to understand that you are saying most of your SGOs were already in existence. It's nothing new. And in the fact sheet, we also defined 65% of our revenue comes out of digital. So why you believe that what will change this time in terms of execution, which will drive the turnaround when most of the focus was there before you joined? So the way I look at it is either you continue with the same team, you have to create an aggression in your review process, or if you find to churn your team, then there could be a results possible, or you believe the combination of both of these things can happen to drive the change. So why should investor believe that if a same old wine is in a new bottle can turn around the growth?
Yeah, Sandeep. So, Sandeep, again, backing up, when I was coming in, uh, two dominant service lines: 85% digital application services, 15% digital foundation services. Okay. Digital application services, this large chunk of business, right, was, like I said, was this massive mass, uh, which had over a period of time become undifferentiated. We had lost, given the amorphous nature of this beast, our ability to drive sharp messaging with our clients, our ability to serve to our field sales force the specific value propositions that they could take to the client. What we have done is, and to give you a view, in this amorphous mass, we had experience, we had engineering. Experience was a little better defined because foolproof Indigo Slate, but engineering, data, platform related work around platforms such as Salesforce, etc., right? Core application development, maintenance was spread out. What we are doing now is we are putting structure to it where none existed earlier. So what was one DAS is now 1, 2, 3, 4 structured set of services, further crystallized, which again did not exist in this high resolution, fine grained mode in which it is going forward, is supported by 2 to 5 specific high resolution playbooks per SGO, right? And each, without going into too much detail, each one of these playbooks have 4 components: level 1, level 2, level 3, level 4. L1 is mandatory for everybody to understand. L2 is where the strike force teams come in, etc. Right? The amount of thinking that has gone into identifying these playbooks and designing the playbooks and documenting it in terms of, and then creating material artifacts for go to market and for delivery is significant. Now, all of this was all scattered all around. We put structure and we put a crystallized set of high resolution, fine grained playbooks that we are going to go to market with. Going forward, the guy on the ground knows what to sell, who to sell to, how to spot an opportunity in a much better fashion than existed in the past. This is the big, big change. Okay. Now, your second question in terms of, what do we do with people? So first of all is when you serve to these folks on the field in pre-sales and even senior delivery leadership, when you serve to them the services as crystallized as I just described to you, it makes their job easier. It makes them much more effective in the conversation that they are having with the customers and the prospects. Okay, so it just improves and increases their effectiveness in go-to-market. Having said that, I was lucky to inherit a sizable part of the team which was strong. We just made things clear for. We've removed ambiguity from the equation. Okay, and then we are augmenting that team with fresh blood. So there were open positions we are fulfilling. We are increasing our hunter headcount. We are increasing our farmer headcount. We are bringing in new leadership into the firm, both in terms of market leadership and pre-sales and delivery leadership, right? So consolidate, strengthen the existing core, and bring in new leadership as needed, just to bring in the right diversity, because diversity drives vibrance, right? And then rotating a few people from within the existing leadership just to make them more effective and giving opportunity for strong leaders to drive bigger and better portfolios.
And just a follow up, in your review process, will you change your performance metrics you want to measure on an ongoing basis? What would be the incentive plans being structured? Because that kicks in the kicker and the aggression within the sales team. So if you can share some detail around that.
Right. So according how we put the structure, the definition of structure, the crystallization of services, how we track the activity in the market has also enhanced in terms of resolution. But the broad metric, was never a problem. How you drive, how you count sales, how you look at pipeline, how you look at order booking, how you look at customer satisfaction, how you look at delivery metrics, how do you look at employee satisfaction, that remains unchanged. But there are a few tweaks, right? There are farming metrics that we are tracking a little closer. There are associate productivity metrics that we are tracking a little closer. There are metrics around how we build pipeline that we are sharpening. So it's few tweaks here and there. Broad metrics remain the same, but yes, there are a few tweaks to better evaluate the effectiveness of our go-to-market and productivity of the sales teams.
Okay, okay. And just a last question, bookkeeping maybe. Do you believe most of the client-specific issue which you have said during COVID time, you had a portfolio of client-specific issue which impacted you more versus some of the peers, are largely behind, and maybe starting from FY22, we could be on a positive growth trajectory rather than flattish to a decline?
So what I can tell is that we see them stabilizing, and as they stabilize, our trajectory with them should improve.
Okay. Thank you, and all the best.
Thanks. Thanks, Sandeep.
Thank you, Sandeep. The next question once again comes to us on the Q&A chat. There has been a significant improvement in working capital over the recent quarters. What has led to that, and is that sustainable?
Namit.
Yeah, sure. So actually, we have leveraged technology very significantly in terms of improving our collections process. In addition to that, we have also set the operational rhythm pretty right so that we are able to convert the unbilled revenues into billed and collect the billed revenues fast. So that has actually helped us very significantly in terms of improving our DSO metric. Our DSOs I would say about 5-6 quarters back used to be around 100 plus, which systematically we have been able to bring it down to 87 by the previous year end, and now we exited the last year at about 77. So it's a mix of the operational rigor that we have been able to put and the process tightness that has been introduced. We believe the reduction which we have been able to achieve is sustainable. There could always be some sporadic up and downs which happen, and that's where we believe the DSOs could range between say 75 to 80 days, but it will never go back to the previous levels as it used to be, and we should be able to maintain a very healthy cash flow going forward, in line with how we have improved over the last couple of years now.
Thank you, Nabi. The next question comes to us from Ashish Agarwal. Ashish, please unmute your line and ask your question.
Yeah, thanks. So most of my question have been answered. Just two questions, and correct me, I'm asking this question as an outsider. But if you look at Zensar, our acquisition strategy historically has failed to accelerate our growth, be it through an acquisition of Akibia, Professional Access, or in recent time Keystone, Indigo Slate, etc. So how are we making sure that this time things will be different and some of these tuck-in acquisition will help us accelerate growth for us? Yeah. And secondly, last 3-4 years, right, and that has been a commentary that the deal signings have been strong. Obviously, with the growth rate not being there, it looks like that some of there's a lot of leaking buckets, so to speak, a lot of clients which are going away or projects not getting renewed. How are we making sure that our farming of some of these clients help us in sustaining the deal wins, which are help us in accelerating growth? That would be really helpful. These two questions. Yeah, thanks.
No, thank you. Look, without going into the past, right? I think the acquisitions have been good. It changed the company's capability. It brought new capabilities, good people, new clients. Going forward, the important difference between what we did in the past. I mean, the strategy of tuck-in acquisitions remains unchanged, right? That we will continue to do tuck-in acquisitions, but in the future, what is extremely clear, Arjun runs corporate development, and we are constantly evaluating what's out there in the market that we can go acquire. Any opportunity that we look at now has to fit in this SEO structure, has to support one or more of these SEO structures, of these SGOs. What that allows us to do for these acquisitions and looking into how we consummate this acquisition is that it fits into a structure. It is embraced by a team that is already in place. So our ability to leverage the acquisition, bringing in support from the existing Zensar organization is sharper, better, right? And it just gives us a very clear path in terms of what we want to achieve through that acquisition, right? So in the future, we believe that given how we want to align all acquisitions under this SGO structure, our ability to consummate the acquisitions is going to be significantly more fruitful. We believe that. So that is the answer to your first question. Can I get your second question again,
So
please?
my question was around farming. If you look at our client bucket,
absolutely. Yeah, I got it. You're right. So one of the issues that we have suffered from is what we call as the leaky bucket syndrome. So we win a lot of deals, but then because of project completion, etc., we also leak a lot of revenues. The massive focus going forward is that the inflow has to substantially outpace the leaking bucket, right? So what we are doing in terms of qualified pipeline, right? So we are tracking increasing amount of much sharper metrics than we have in the past. How we are tracking qualified pipeline, right? Vis-a-vis overall pipeline, the conversion of qualified pipeline, and how that feeds into the pipe, and how that needs to outstrip the leak is what we are focused on, right? And as we fire along these SGOs, right? Experience, engineering, data, application, and infrastructure. As our playbooks start firing, we see that piece outstrip and outpace the leak, right? In terms of the leak itself, look, that is a part of business as usual. We can arrest some of that. Some of that is just business as usual. Projects getting completed, projects getting over. The resolution of that is that the inflow needs to significantly outpace the outflow. Can it be? And it's not just us. It's within the industry peer group, right? And the resolution for that is significant uplift of how we bring in new business, how we drive qualified pipeline.
got it. And lastly, sir, for us, there is the largest client, right, has a disproportionate share of our revenue. Right? If I'm not wrong, it's 20% plus. Do you think that that could be a hindrance for growth, overall growth rate as a portfolio, or do you think that client has the capability still to grow in line with the company average?
So the way I'd like to answer this question is that mid-cap companies like us, the client map is not too dissimilar, right? There's one or two anchor clients, and then so going forward, right, the way we have looked at our clients is there are basically four broad categories, which is platinum, strategic, growth, and tail, right? Our objective is always to keep increasing the upper piece of the pie. So just to give you that overall view. In terms of our largest clients, we continue to, even though the proportion of, the size of volume has shrunk, revenue has shrunk, but we continue to keep the proportion of wallet share intact. Our wallet share remains intact. We constantly look to drive value within those relationships, value to the clients, and looking to follow where they are investing. So to give you an example, a couple of our largest clients where our traditional business has been in core IT, and as they have expanded into other areas of technology spend, we have followed that spend. We have successfully increased our pie in non-traditional areas. So we will continue to double down. We are not ceding ground in that, right? We have put very strong teams. Couple of places after coming in, I have made tweaks to make sure that we continue to accelerate, continue to drive good business with these clients. And then, like any prudent business would do, is to expand outside of these core platinum clients, expand that piece. And that's another huge area of focus, both in terms of sales, pre-sales, delivery.
Got it, sir. Thanks a lot.
Thank you. The next question comes to us on the chat. South Africa is a unique geography for Zensar compared to many of the other mid-cap players. How does this fit into the overall strategic direction for Zensar?
So we dominate South Africa, right? We are number one, number two in South Africa. We work with the top companies in South Africa, and we deliver extremely good value to them. And these are very, very long-standing, loyal clients. And then as we look forward, and we've operated in this traditional model of, global delivery with them. As we look forward, I think there are opportunities which we have traditionally not driven in South Africa in terms of an expanded footprint of how we service these clients, where we service these clients from, right? We are looking at all of those adjacencies very seriously. We have started activating some of that. And South Africa, I am sanguine, will continue to drive big proportion of South Africa as a portfolio will continue to thrive and drive growth. Very, very positive about what's happening in South Africa for us.
Thank you, Ajay. The next question also comes to us on the Q&A chat. Can you expand on the playbooks which you are developing for each SGO? How will they tie into the overall vertical horizontal strategy?
Good question. 2 to 5 playbooks per SGO, coming up with a total inventory of the firm's playbooks, of which a proportion of those are identified as priority playbooks, right? Which can be used across the firm, across the verticals and geographies to drive our go-to market and to capture demand. For the verticals, each one of these, for the verticals, they take these playbooks and they apply their vertical flavor where needed. So to give you an example, experience services is, the SGO under this, we've got a few playbooks. And the playbook for consumer services will have a slight tweak versus the same playbook for banking, right? Which will have their vertical flavor. That vertical flavor overlay is something that our vertical teams are doing and working on, right? So it's a good question, right? So we take, and then outside of the vertical flavor that is applied on the playbook as needed, there are certain playbooks which are completely vertical specific, which they will drive entirely on their own. To give you an example, our insurance business does thriving work, solid work around the Guidewire platform. So insurance Guidewire business is an insurance playbook, which is only an insurance playbook. So there are some of those which, depending on the verticals that we operate in, will be specific vertical specific playbooks. Vertical specific playbooks.
Thank you, Ajay. The next question comes to us on the chat again from Sanjeev Goswami. How do we measure our success with clients objectively? Are there any data points that are being tracked?
So, Sanjeev, broad metrics for a client are, look, we are, first of all, let me start by saying we are, which is, the classic metrics are top line, bottom line, client satisfaction, and the satisfaction index of the associates that are working for the clients. Are they the happy associates will do better job for the clients, right? And then there are extended metrics like, for example, our ability to drive thought leadership with them, our ability to drive and partner with them on their strategic agenda, which basically translates into what are the proactive conversations we are having with them, right? That is a metric that we are tracking. And there are similar such metrics that we are tracking in terms of how we drive both mind share and market share with the clients.
Thank you, Ajay. The next question comes to us from Deepesh M. Deepesh, please unmute your line and ask your question.
Yeah, thanks for the opportunity. Couple
Hi,
of
Deepesh.
questions. Yeah, hi. Good morning. Couple of questions. First, I think so far, I think you partly addressed most of the question about why growth rate was not happening. Now, considering some of the things which you would likely to tweak and expect that to result into better growth trajectory. So, what would be your, let's say, next 3 to 5 year aspiration for Zensar? And how you expect earlier, let's say in earlier Zensar was a Oracle house and known for Oracle capability. In let's say next 3 year, 5 year, how you expect Zensar to be known about in terms of specific capability to make it clear, differentiated compared to let's say some of other peers. So if you can provide some perspective in next 3 year, 5 year perspective, what area you will invest, which clearly differentiate Zensar 3 year out, 5 year out. And then your vision about, let's say, how you expect Zensar to be known about. Either you can give some perspective on scale perspective. If let's say scale, you don't want to go into that detail, but capability wise, let's say you prefer to give some color about 3 year, 5 year vision. Thanks.
Yeah, Deepesh. So Deepesh, I actually have a very short answer for you because it's something that we track very, very carefully. So first of all, is 3 year, 5 year view is, again, back to the point. Where we want to get into is a rhythm of sustainable, predictable, profitable growth. Okay. Clear objective. So that's one part of the answer. The second part is, and you saw that in a couple of slides, but very, very clearly, our positioning in the market is experience-driven engineering and experience-driven infrastructure. We have created an experience capability which is very unique, which is very differentiated, which especially in the mid-cap peer group is unique. And then supporting it is the focus we have on engineering, right? Both in terms of engineering to catch experience-related demand and engineering to address the massive burgeoning demand in the area of cloud-native full stack. The demand that is exploding in data engineering, analytics, and AI/ML. We are positioning. We are going to be known in the market. We, in fact, are already set up that way, and we will continue to drive towards increased differentiation through experience-led engineering and experience-led infrastructure services. It's a unique market positioning for us.
Understand. Any quantification target you have, let's say, for experience-led infra or experience-led engineering, from where currently around, let's say, 10% advanced engineering and all those numbers you share. Any quantification target you would like to share with us?
Yeah. So Deepak, what I can share with you is that these practices will grow disproportionately. The growth, and just let me emphasize, the growth of these SGOs will be higher, disproportionately higher when compared to others. that I can
Understood.
share. Yeah,
Thanks.
sure, Divesh.
Thank you, Dipesh. Next question comes to us on the Q&A chat again. Since your arrival at Zensar, what are the key things which stood out as positives and as strengths of the organization?
Solid foundation, great set of clients, very loyal to us, uh, happy with the work we do. A very, very continuous input that I got is, look, if we are in trouble, you guys are one of the first people we call, right? But also a high set of expectations, right? That going forward, we continue to expect you. So high set of expectations. So solid foundation, great clients, passionate bunch of people, right? Passionate associates. And finally, it's a very process mature, resilient organization, which kind of feeds back into the strong foundation narrative of the firm. So that is what I found coming in.
Thank you, Ajay. The next question comes to us from Devang. Devang, please unmute your line and ask your question.
Hi, sir. Am I audible?
Yes, Deepak.
Yes. So, in order to address that leaky bucket, you are focusing on increasing your deal pipeline. But do you have any plan in increasing the annuity type or that kind of revenues? And if what kind of quantification right now you have, what kind of target do you have to achieve that annuity kind of revenues?
Yeah. So Devang, short answer is yes. Okay. But let me give you a little more detail. Just double click on that. Annuity revenue comes from basically three buckets, broadly, give or take. One is application support, second is infrastructure support, third is where you capture areas within the client towards big change projects that you're doing. So, when you're in a change bucket, then as the client expands that portfolio, expands the spend, you are a natural partner for them to ask for services and talent. This is three categories. So, it's not just app and infrastructure support. Annuity also comes from a third bucket. Now, bucket number three, we can play across the range of clients, from Fortune number 1 to Fortune number 2000 on bucket number three. On bucket number 1 or 2, just the nature of our business, is such that for the largest clients to drive these huge multi-year billion-dollar deals, etc., they typically go with the big five. But then the minute you come a level below the largest clients, when you start hitting the mid segment and the small segment, is where mid-cap firms like us start playing, right? And we continue to focus on that. Our pipeline in that segment continues to remain vibrant, continues to remain good. And Devang, we are focused on all of these three buckets. And the last point is increasingly app infra is converging. So the three buckets may become two buckets or remain three buckets. We are tracking that market trend also very carefully.
So, sir, can you quantify how much is it right now and how much is your target as such for, these revenues?
How much we have right now, I don't know. Navneet, do you have the numbers off the top of your head?
Sorry, in terms of which clients' revenues are you seeking?
So the two buckets, annuity versus.
So I think annuity versus this thing we have not been disclosing externally at this moment. So I would not put a comment on that right now.
Okay, thank you.
Thank you, Devang. The next question comes to us on the Q&A chat from Debashish Majumdar. What do you think is the growth driver of Zensar going forward? Unique positioning in few and new services, or better execution of commoditized old services and thereby capturing higher mind share?
Both, right? So tip of the spear is experience. Experience-led engineering and experience-led infrastructure services are two very clear market positioning aspects of Zensar. We will continue to drive a lot of momentum. We see a lot of deal work, activity, and will continue to drive momentum in experience, advanced engineering, data engineering. In our core set of services, which is application services and what we call is experience-driven infrastructure services, we have a very unique solution in that space that resonates extremely well with the market. Pipeline is good. We will continue to drive that as well. So it's not one or the other; it's both.
Thank you, Ajay. The next question comes to us from Sandeep Shah. Sandeep, please unmute yourself and ask your question.
Thanks for the follow-up. Ajay, you want to redefine the way we define in the fact sheet the digital services, which we see it as 65%, or we believe currently we get 65%, but if you can break down, because you said 10% comes out of customer experience, 10% comes out of advanced engineering. So what would be the balance 40-45%? And second, the way we look at a mid-cap company having an edge in the digital has been spoken by most of the management, but where the mid-cap differentiates the large cap is through sub-vertical focus as a whole. So besides our SDO, which verticals where you believe Zensar could be a preferred vendors versus the others, and which can drive you the momentum which you want?
Yeah, good questions. Sandeep, let me go, and then I might tap it to Navneet first. So first of all, is digital is much more than only experience, by the way, right? Digital is experience. So the way I like to describe, just backing up, right? Digital is a confluence of design, engineering, data, and velocity. Now, digital is much more than experience. Digital is experience. Digital is platforms. Digital is as a service. Digital is redefining architecture in what can enable you to provide better product platform view so as to drive agility and speed for your business. Digital is how you deliver even traditional services in this new digitalized world to drive better customer experience, better customer satisfaction. To give you a view, in infrastructure services, we have completely changed how we go to market and how we solve for our customers' problem. We start with the solution for our customers' problem, starting with who is the end consumer, what is their persona, what are the journeys they undertake, and how can we enable those journeys better, and how can we enable these personas better. So digital is more pervasive than just experience, right? Digital is experience, digital is agility, digital is cloud, digital is driving microservices architectures to provide product and platform services. Digital is how you drive experience across the value chain through how you track personas, how you track your journeys, and how you design systems to better drive those journeys and enable personas, end actor satisfaction. So that is a very, very clear, view I wanted to give to you in terms of what is digital, right? And yeah, so I think that should answer the core question that you had. Is that's not how you look at it. It's 10, 10, and the remaining 45.
Okay. And in terms of a question on sub-vertical focus, where you believe Zensar differentiates versus others?
Yeah. So we have deliberately kept to 3 verticals: banking, financial services, insurance, high-tech manufacturing, and consumer services, which also include retail, right? We have deliberately stayed out of, the conversation that I have with the team and with the board, had them consistently over the last 5 months that I've been in place, is Should we stick to these three verticals? Should we look at other verticals, etc.? Key is, how do you manage your investment dollars? How do you don't manage the overhead that is needed? How do you make the right choices? The choices about what you do and what you don't. So these are the three verticals. And the vertical strategy is also, vertical dependent. So for example, for our high-tech manufacturing vertical, the big focus is how are we going to proliferate Industry 4.0? How are we going to enable our clients to drive the as a service model as strongly as possible? You look at banking, financial services, insurance. Banking for us is being driven through micro verticals and value streams. So for example, within banking, we have retail, we have cards and payments, we have uh, corporate commercial, we have capital markets, which is further divided between buy side asset wealth management and sell side investment banking. Our approach towards banking, just the nature of banking is such that our approach is based on these verticals, micro verticals, and value stream. Similarly, for insurance, it's property casualty and life and annuity. And within that, you've got small, mid cap, and large cap. Small, mid, and large size insurance clients. And then thirdly is consumer services, which is retail, both big box, grocers, uh, apparel, and other retailers. And we actually segment them to make sure that the value services, in the sense that, of course, there is core retail functions which are common across all retailers. But there is enough of, messaging tweaks that are needed depending on which customer you're talking, whether it's big box retailer or grocer or apparel or furniture or and then you've got consumer services business, which there's a lot going on in consumer services business in their core in terms of what they're doing with respect to D2C, direct to consumer, etc. And then there is activity around travel and hospitality. So each vertical has its own specific way based on the market dynamic of the vertical in terms of how we go to market in that vertical. And then there are value stream items, which is e-commerce, experience-driven commerce, driving creative content services to deliver promise of the brand, and then supply chain, merchandising. So this is the retail value chain. So we track that very carefully, very customized, tailored to the particular vertical that we address. I know all this. I can recite this, so easily because this is the way we review these verticals.
Okay, thanks and all the best.
Sure.
Thank you, Sandeep. Unfortunately, that's all we have time for today. Thank you, Ajay and Navneet, for an interesting and interactive session. Thank you to all the members of the audience for your time and questions. We hope this was interesting and informative for you. Unfortunately, this concludes the RPG Annual Investor Conference as well, this being the last session. Thank you all for your enthusiastic participation, and we hope to see all of you soon. Thank you and stay safe. Good evening.
See you.
Thank you. Bye.